Welcome, aspiring traders, to a deep dive into one of the most powerful tools in the intraday trader's arsenal, Trendlines. Today, we're going to unlock the secrets of consistent profitability in the fast-paced world of day trading. Our core objective is simple yet profound: to equip you with the knowledge and skills necessary for profitable intraday trading. We will leverage Trendlines as our primary tool, transforming what many perceive as a gamble into a strategic, repeatable process. Think of Trendlines not just as lines on a chart, but as your personal roadmap to consistent profits. They provide clarity and direction in volatile markets. Intraday trading holds an undeniable appeal, promising quick profits and exciting opportunities. However, success in this arena hinges critically on understanding market trends. Without this understanding, you're simply guessing. This is where Trendlines come in. They are a powerful visual tool that helps you identify and capitalize on market opportunities. By the end of this session, you'll see how these simple lines can revolutionize your trading approach. Let's begin with the fundamentals. What exactly is a trend line? A trend line is a straight line drawn on a chart by connecting two or more price points, extending into the future to act as a line of support or resistance. It visually represents the direction and strength of a trend. To accurately draw a trend line, you need at least two significant price points. For an uptrend, connect two or more consecutive swing lows. For a downtrend, connect two or more consecutive swing highs. The more points a trend line touches, the stronger and more reliable it becomes. There are essentially three primary types of trend lines, each with distinct implications. An upward trend line, also known as an ascending trend line, connects higher lows. It signifies bullish sentiment, indicating that buyers are in control and pushing prices higher. This line acts as dynamic support. Conversely, a downward trend line, or a descending trend line, connects lower highs. This type of trend line signals bearish sentiment, showing that sellers are dominating and driving prices lower. It functions as dynamic resistance. On the other hand, a sideways trend, also referred to as a horizontal or flat trend, is a market condition where an asset's price moves within a tight range, showing no clear upward or downward direction. This pattern is marked by price oscillations between established support and resistance levels, often signaling a phase of market consolidation before a possible breakout or trend reversal. It functions as dynamic support and resistance. Trend lines are not static boundaries. They are dynamic levels that evolve with price action. An upward trend line acts as a dynamic support level, meaning prices tend to bounce off it as they move higher. It provides a clear area where buying interest is likely to emerge. Similarly, a downward trend line serves as a dynamic resistance level. Prices often struggle to break above it, indicating strong selling pressure. This line highlights areas where sellers are likely to step in and push prices down. Understanding these dynamic properties offers crucial insights into potential price reversals and continuations. When price respects a trend line, it suggests the trend is likely to continue. A break, however, signals a potential shift in market dynamics. Now that we understand what trend lines are, let's explore how to read them to spot concrete trading opportunities. The most significant signals from trend lines are breakouts and breakdowns. Identifying these correctly is paramount. A breakout occurs when the price decisively moves above a downward trend line. This indicates a potential shift from a bearish trend to a bullish one. Look for strong candle closes above the line, confirming the momentum. A breakdown, on the other hand, happens when the price decisively moves below an upward trend line. This signals a potential reversal from a bullish trend to a bearish one. Again, confirm with strong candle closes below the line. These identified movements translate directly into trading entry signals. A breakout above a downward trend line often signals a potential buying opportunity. It suggests that the selling pressure has subsided and buyers are now taking control. This is your cue to consider going long. Conversely, a breakdown below an upward trend line signals a potential selling opportunity. It indicates that the buying momentum has weakened and sellers are gaining dominance. This is your cue to consider going short. However, never trade solely on a single signal. Confirmation and validation are absolutely crucial to avoid false signals and protect your capital. Always seek additional evidence before entering a trade. One powerful way to confirm trendline signals is by using other technical indicators such as moving averages. For instance, a breakout above a trend line is stronger If the price also breaks above a key moving average, like the 50 period or 200 period simple moving average, this confluence of signals provides greater conviction. Another excellent confirming indicator is the Relative Strength Index, or RSI. If a trendline breakout is accompanied by the RSI moving above 50 or showing bullish divergence, it adds significant weight to your trade idea. Similarly, a breakdown with RSI moving below 50 or showing bearish divergence strengthens the short signal. The strategy to avoid false signals is multifaceted. Always wait for a confirmed close beyond the trend line, not just a wick. Look for increased volume accompanying the break, as high volume validates the move. Finally, combine trendline analysis with other indicators and price action patterns for a robust trading plan. The true power of trendlines comes from integrated analysis, that is, using trendlines in conjunction with other technical indicators. For example, if a stock price makes a breakdown below the 50-day simple moving average, and simultaneously the RSI indicator shows a bearish divergence, this confluence strengthens the resistance level. This scenario provides an opportunity to go short. Similarly, if a stock price makes a breakout above the 50-day simple moving average, and simultaneously the RSI indicator shows a bullish divergence, this confluence strengthens the support level. This scenario provides an opportunity to go long. This hands-on approach, even in a theoretical discussion, is designed to solidify your understanding. By visualizing these scenarios, you begin to internalize the patterns and reactions. It's about building muscle memory for your trading decisions. The aim here is to build your confidence in applying these concepts in real-time trading. Confidence comes from understanding, practice, and seeing how these tools work. You'll start to see the market not as random noise, but as a series of predictable patterns guided by trend lines. Trend lines are your first line of defense and offense in the market. They help you identify trends, spot reversals, and pinpoint high-probability entry and exit points. Mastering them is a cornerstone of successful intraday trading. So, if you like this video, like and subscribe for more information on how to build a winning trading structure for intraday trading.